According to Federal Reserve data, US households now have 45% of their financial assets in stocks. That is higher than at the peak of the dot-com bubble, higher than 2007, and the highest level on record. When markets rise, investors tend to chase performance. When markets fall, they retreat. That herd behavior is not new, but what makes today different is how extreme the positioning has become. Right now, the public is more committed to stocks than at any point in modern history. This is not just retail investors. Institutional investors have also increased equity exposure to levels last seen in late 2007, just before the global financial crisis. Pension funds are doing the same. Their cash allocation has fallen near record lows, while equity exposure has climbed above 85%. Mutual funds are similarly positioned, with cash levels near historic lows. Corporations are aggressively buying back shares, a behavior that historically peaks near market tops. Even foreign investors are piling in. Historically, foreign capital tends to flow into US equities most aggressively near major market highs, including 2000, 2007, and 2021. Today, foreign exposure is again near record levels. Every major group is leaning in at the same time. What makes this cycle more fragile than previous ones is leverage. Margin debt recently hit $1.13 trillion, a new all-time high. That is more than 20% above the peak reached in late 2021. But traditional margin debt is only part of the story. Leveraged equity ETFs have exploded. 5 years ago, there were roughly 200 leveraged equity ETFs. Today, there are over 700. Assets in these products have surged from roughly $30 billion to nearly $130 billion. Retail speculation has also shifted towards short-dated options. Zero-day options now account for more than 60% of total options volume. This is a market heavily dependent on leverage and short-term positioning. All of this is happening while valuations sit at historic extremes. A composite valuation metric that combines earnings, market cap to GDP, and price to book recently hit a new all-time high, exceeding levels seen in 1929, 1999, and 2007. Price to sales for the S&P 500 has reached 3.4, far above the dot-com peak of 2.1. Unlike earnings, sales are difficult to manipulate. Either revenue exists or it does not. Then there is the Buffett Indicator, which compares total market capitalization to GDP. Warren Buffett once called it the best single measure of market valuation. Today, it sits at 2.19 times GDP, far above previous market peaks. Historically, valuation extremes like this have preceded major drawdowns. Some argue that Bitcoin is different, a new store of value. But when Bitcoin is overlaid on the market cap to GDP ratio, the pattern is clear. Bitcoin rises and falls with the broader market. Tops and bottoms are not perfectly aligned, but they are close. Bitcoin behaves like a speculative asset, not a hedge. If equities decline meaningfully, history suggests Bitcoin will follow. While investors chase risk, Warren Buffett is doing the opposite. Berkshire Hathaway is holding over $380 billion in cash, the highest level in its history. Buffett is not bearish by nature. He simply waits for value. When the most disciplined value investor in history cannot find opportunities, it is worth paying attention. Today, stocks are expensive, leverage is extreme, and participation is universal. That does not mean a crash is imminent. Markets can remain elevated longer than expected, but historically, when everyone is all in at the same time, future returns tend to disappoint. Risk is not about headlines, it is about positioning, leverage, and valuation. And right now, all three are stretched. Want to know how we trade this major technology trend? At Truthsayer AI, we trade every single one of the alerts our AI generates. If you are interested, you can join the thousands of clients already on our app who are taking advantage of these trades every day. Remember, we trade every one of our alerts our machine learning and AI models generate. Sign up on our website. You won't regret it. Thank you for watching, and don't forget to like and subscribe.